Look, next to losing weight, buying a house is probably one of the most common New Year's resolutions for a lot of people. But unlike losing weight, which really doesn't cost you much except for maybe stop eating chips and junk food and maybe drinking Coke and probably just exercise a little bit more than what you do, buying a house has some really big money outlays out of your pocket. You have to account for your down payment, your cost of buying the house, and in some cases, especially in this crazy, ridiculous market that we're living in right now, maybe even pay a little bit more for the house than what it's actually worth if you're finding yourself fighting against other people. So because we're coming towards the end of the year, I thought it would be a really good idea to make this video for you guys to show you some different things, some different ideas, slick ways, I would call them, just thinking outside of the box, you know what I mean? Just to create some money and help you save some more money for your future home purchase. Maybe I shouldn't say create money because I think Jay Powell and the Federal Reserve are doing a lot of it right now, just printing millions and millions, trillions of dollars every single month pretty much. But I guess that's another topic. Anyways, the strategies that I'm gonna show you here in this video are strategies that I've personally used and currently I'm using right now for my next home purchase. I've used this before, I'm gonna do it again, and I'm actually doing it right now. But with that said, guys, this is not financial advice. This is basically just ideas that you can implement for yourself if you are thinking about purchasing a home. Or what the hell, maybe you're just thinking about purchasing anything, okay? And you just wanna make your money grow a lot faster, or maybe you're just starting from zero and you just wanna go ahead and get to that point so that you can buy whatever that is that you want. In this case, the video is about buying a house, so there you go. But now with that also said, these strategies are not for the faint of heart, okay? So I know some of you guys might disagree completely with what I'm doing, and that's totally fine. Listen, you're entitled to your opinion. But again, you know, I do a lot of research about the topic, basically every single resource that I was able to find. And look, personally, I've been doing mortgage loans for almost a decade now, and everybody sort of has the same thing, you know, just the same boring cookie cutter advice, which is just save some more money, put it into a savings account, a CD, and just rinse and repeat. That very slow and boring. Look, with enough risk management, diversification, and due diligence, you should be able to mitigate a lot of the risk of the strategies that I'm gonna be talking to you about. But before we jump into them, a couple of things just to make things very simple for you. Now, the first one is that I'm actually assuming that you're gonna be purchasing your primary home, which is gonna help you get a low down payment loan. And that could be either a 3% conventional mortgage or a 3.5% down payment loan like an FHA mortgage. So to keep things very simple for you, and again, easy to understand, I'm also gonna assume that you're buying a $400,000 home, which is the median sales price of a house right now. So basically you're gonna have $12,000 for your down payment, and let's call it 2% for your closing costs, so that's about $8,000. There you go, 20,000. So we're gonna be shooting here for 20 grand for your whole transaction. Okay, with that said, let's go ahead and get started. So the easiest way to stack some money for your down payment and your closing costs and buying a house is gonna be cutting some money going out of your pocket. That's right, listen, I know the first strategy is not gonna be like so mind-blowing, right? I guess everybody could have told you that, but we have to start with just cutting expenses. And I'll give you one simple example. The average American household spends about $3,000 a year just dining out. So that's basically just going to restaurants. And I think personally that's a lowball amount because, look, I'm sure as hell that if you live in a big city where if you're in your 20s, in your 30s, in your 40s, you're single, or you have a significant other, and you guys are dining out on a Friday, Saturday night, you're spending way more money than that. Like literally, I live what I could call a pretty big city. I live in Atlanta, Georgia, and I live in I live in the city. So every time I go out with my girlfriend, it's literally $100, $200 just to go have a couple of drinks, go have some food, right? So I think that's a low ball, the $3,000 a year. It's more like $6,000 a year, at least personally. So with that said, if you can save an additional $500 a month, which in my opinion is very standard and very possible, just from stop dining out so much, or maybe if you're pounding shots at the bar with your friends, that's gonna in turn help you save on Uber trips, and also is gonna help you save on DoorDash trips. Because, well, I mean, let's face it, you go and pound some shots, you're gonna have a hangover the next day, you're gonna have to go get a big fat greasy burger and some fries and some ketchup that's gonna run you another $25. So like it adds up, you know what I mean? But okay, fine, fair enough. Maybe you don't have the lifestyle, but you do like eating a lot of avocado toast on a Saturday, Sunday morning, and it's costing you $20, $30 to do so, look, stop, okay? You can go and put together an avocado toast with just probably 50 cents. You go and buy an avocado from the grocery store. You can even go to Whole Foods and get one for $2 and then get some bread for $3. You can put like 10 avocado toasts for a whole total of $5. So anyways, start saving some money that way. But for now, we're just gonna call that you're gonna save about $500 a month, which is, again, the equivalent of $6,000 a year. And later on in the video, I'm gonna show you guys what to do with this. But okay, maybe you don't have that issue, and I guess that's good for you, but maybe you do have other things, right? Some other money outlays, like you probably have some personal loans that have a pretty high interest rate. You have some credit cards. So what you wanna do, guys, is you want to consolidate all of that stuff into a low APR personal loan. Now, in my opinion, and this is my opinion only, they're not sponsors of the video or anything. If anything, I guess I'm giving them free traffic. SoFi.com is my favorite personal loan website. They offer some really low interest rates and they have no origination fees. Now, they do kind of require a pretty good credit score and good income in order to qualify, but overall, I think based on all the personal loan sites out there, SoFi.com has the best one, hands down. But listen, if you feel pretty confident that you can pay off your credit card debt, maybe just like right after you buy the house, they'll probably consider doing like a credit card at a 0% interest rate. So obviously these are credit cards that offer you a 0% introductory rate at the beginning, probably for 12, 15 months. And this way you can just consolidate all the high APRs into no APR, which obviously is gonna help you save on the interest expense. And at the same time, it's gonna help you just save on how much you're gonna pay every single month. And obviously here, we're trying to save money for your house. So obviously keeping more money in your pocket is what we're trying to do. So this could be a pretty good idea. However, guys, just make sure that before that new interest rate starts to kick in, make sure that you have the credit card paid off in full, or at least paid off, very close to being paid off in full. That way you don't have a lot of interest expenses anyways, all right? Now, the next one, guys, is gonna be creating more money. Okay, so we're number two. You're probably gonna be like, Marcos, all right, I mean, this is like stuff that I could have heard anywhere. But listen, we're setting out the foundation because we're gonna talk a little bit about more what to do with it. But the second one, like, it has to be making more money, man. And like, honestly, I know it's gonna take some work. You're gonna have to do a few things here and there. You can't just rely on your main job for your main income. You know, on average, most millionaires have multiple sources of income. I'm not gonna say that you're gonna be a millionaire. Hell, if you are gonna be great, hope you are. But on average, most millionaires actually have more than 5 sources of income. I'm asking you just to have a second one, and it doesn't have to be mind-blowing. But literally, the easiest way to saving more money is, well, no shit, by just getting more money from somewhere else. So get a side hustle, or rather just make your own. But if you don't really have a skill where you could say like, man, I can just sell this skill to the marketplace. Look, you can like literally just go and drive an Uber or deliver food on DoorDash if you have to, or do Instacart, whatever the case might be. Go walk dogs on Rover. Look, honestly, it doesn't really have to make a ton of money here. And if you just make probably an additional $1,000 a month, you're gonna be great. Because $1,000 a month on side hustles is like literally not very difficult. So for instance, guys, I personally have an awesome side hustle that I literally do from home. It takes me maybe 3 to 5 hours. I only do it one day a week. I do it on Sundays, and then every Sunday I go and check it out. The side hustle that I have is that I run Facebook, Instagram, and Google ads for just business owners and real estate agents. Now, I don't have a ton of clients because I don't need to have a ton of clients, but each client that I have, I charge them $700 for me to run their Facebook and Instagram and Google advertisement. So there you go. It could be just literally that easy. And if you have a very good skill set, like some of you guys might be very good at video editing or photo editing or just taking pictures out, maybe reselling them, whatever the case might be. Listen, $1,000 a month, that's like $350 a week, okay? Anybody can do that. You can go and serve tables and do that, okay? But anyways, so far we got $500 a month, which you basically saved on cutting back on expenses, plus the $1,000 a month in additional income. That puts $1,500 a month in your pocket, which is $20,000 for the year. And literally you can stop right here because we said that our target was gonna be $20,000 for a $400,000 home. So in 12 months, you start now, Then by November, December of 2022, you already have the 20 grand for your $400,000 mansion, okay? All right, but I get it. Look, you didn't come this far in this video just to hear about saving money and also getting a side gig, okay? Anybody could have told you that. So fair enough, we're gonna go and talk a little bit about taking a little bit of risk to grow this amount. And honestly, guys, the first strategy that I have here for you isn't really that risky to begin with, at least not personally. But what we're gonna do is gonna be doing two things. The first one is gonna be using power of compound interest, okay? And the second one is we're gonna go over to BlockFi.com. Link in the description below so that you guys can go ahead and get $250 in Bitcoin. So I'm basically putting 250 bucks in your pocket right off the bat. It's gonna go towards your home purchase. But now the reason why I love BlockFi.com is because it pays back 9.5% APY on stablecoin deposits. So what you're gonna do is you got some money in a savings account basically just dying because the Federal Reserve is not getting tired of printing money, and obviously you can see it because, well, even Dollar Tree doesn't even sell dollar stuff anymore. So what you're gonna do is you're gonna convert that cash into stable coin, and then you're gonna put that in BlockFi.com. Again, link in the description box below. So at 9.5%, guys, I mean, crazy. Just in 24 months, you're gonna have an additional $3,000, if not a little bit more, if you just put in $1,500 every single month, okay? That's the power of compound interest. Now, obviously, compound interest works even better the longer that you leave it in and you continuously keep depositing and investing. But I get it, we have a 24-month horizon probably, or maybe 1 year horizon. So it's not gonna do much, but at least your money is not gonna be dying in a high yield savings account that laughably probably pays about 0.25% APY every year, maybe even less than that. But okay, now we're gonna get into a little bit more riskier things because obviously our goal is to outdo the 9.5% by doing the lending on stable coins on BlockFi or maybe even crypto.com. Listen, guys, honestly, there are other platforms out there. You choose the one that you like the most, the one that you feel the most comfortable. Do your research, do whatever you need to do, and you're gonna be all right. But the next strategy is gonna be investing in the stock market. Now, obviously, we know that investing in the stock market carries a lot of risk. You can probably go and buy one single company and the stock price can probably plummet right after you purchase. It's happened to me just a couple of months ago. I bought PayPal. PayPal was doing great. $280 a share, and then as soon as I bought it, basically dropped 40%, okay? So, you know, that can happen in the stock market. Now, PayPal to me is a great company. I'm not gonna be pitching PayPal over here to you guys, but it just goes to show you that a stock, even for a great company that is profitable, can still drop drastically. So to mitigate that risk, what we wanna do is that we want to diversify in different stocks. Now, obviously you have a job, you have a life, and probably stock trading is not your profession or stock analysis is not your professional. Probably that's not something that you do anyways, okay? But there is a way for you to diversify very, very simply, and that is by buying index funds and ETFs. Now here you can buy the S&P 500 through the ETF, the Spider, which has returned about a 10% on average for the last 30 years. But over the last 5 years, listen, it's returned about 12% per year. That's after inflation. However, the S&P 500 has returned about 21% since 2019 after inflation, which is like extremely respectable even by professional investor standards. Or also you can get a little bit more risk adverse by investing in only large cap companies within the S&P 500. So companies such as Microsoft, JP Morgan Chase, Home Depot, Johnson & Johnson. You could do this through the Vanguard Dividend Appreciation Index Fund, ticker symbol VIG, the VIG, and this one is up 25% year to date. Or you can look into the ProShares S&P 500 Dividend Aristocrats ETF, ticker symbol NOBL, the Noble. And the reason why I love this fund is because it focuses exclusively on S&P 500 Dividend Aristocrats, which are high quality companies that just not have paid dividends, but also grown them over at least a 25-year consecutive period, with most of them doing so for 40 years or more. Now, this includes companies like McDonald's, Lowe's, Chevron, Cintas, Coca-Cola, and more. Now, year to date, this fund has returned about 20%, while over the last 5 years, it has returned a very respectable 15% annually. All right, moving up on the risk scale is investing in options. And I know a lot of guys are gonna be like, oh my God, like options are extremely, you sure about this? And look, I know, listen, I get it. Options are they're very dangerous, okay? If you don't know what you're doing, you can lose all your money. Because yeah, they're sophisticated. So please guys, don't do this unless you do more research, you know exactly what you're doing, and you understand 100% what you're getting into. But there is a way for you to actually get into the options market where it can mitigate a lot of the risk. But if you understand what options are, you know that these are one of the greatest financial tools in the history of finance. Now, an option is a contract that gives you the ability to control 100 shares of the underlying stock. In order for me to keep the risk as low as possible and generate income at the same time, what I do is that I sell covered calls, which is probably one of the best ways to go. And again, it's a strategy that I implement for myself. Now, by selling covered calls, you do have to own at least 100 shares of the underlying stock. So you do have to have some capital, obviously, to buy all those shares. Obviously, there are companies that, each share price can be very expensive, like, Alphabet or Amazon or Nvidia, companies like that, or Tesla even. But there are companies where the share price may not be that expensive, and you can definitely do this as well. So if you don't know what a covered call is a contract between two parties where the seller of the contract agrees to sell the underlying stock to a buyer at a specified price on or before a certain date. Now, the buyer of the contract has the right but not the obligation to buy the underlying asset from the seller at that specified price on or before the expiration date. Now, the contract is referred to being as covered because the stock being held by the seller is the collateral for the obligation. So how do you make money here is when the underlying stays sort of flat, meaning that your underlying stock doesn't really go past a strike price, and you get to keep the premium for you selling that contract to the buyer. Obviously, that's the buyer of the contract won't be able to exercise because it doesn't make sense. So you're gonna be able to keep your stock, especially if you like the stock a lot, you want this to happen, but also you're gonna keep the premium for selling the contract. Now, of course, if the stock does move up above the strike price and the buyer executes the contract, then you have to sell the stock to the buyer. But that's totally fine because you have generated two types of income here. One is gonna be the appreciation of your stock by selling it at the higher price in the form of capital gains. And second, by the premium that you collected for selling the call. Now, ideally, if you really wanna keep the stock in your portfolio, you believe in the company, you believe that the stock is gonna grow more in the future, then you kind of want your stock to basically just trade a little bit flat so that it doesn't get exercised. In that way, you can keep the stock and also keep the premium. All right, lastly, I'll give you this one because it is a strategy that, again, I use. It's worked for me. I know it's worked for a lot of people, especially this year, maybe even the year before. But this is the riskiest one of them all. And this is the one that I've been using to grow the most amount of money for my next home purchase. And it is by trading crypto. Now, I've personally been a long-time crypto investor since 2017. I've been through the ups, the downs, to the crypto winter, through every single time that crypto crashes, which is probably once every 2 weeks, maybe sometimes even once every 3 days. But yeah, either ways, I've been in it, okay? Now, I don't need to mention this to you guys, but crypto is extremely volatile. So, if you do have a little bit of money and you don't really want to risk it that much, maybe you just want to stay away from this completely, or at least allocate a very low percentage of your portfolio into cryptocurrency. Because legit, your portfolio can go up 20, 30, 50% in one day, but it can also drop 70% when China decides to ban it for the 10th time, and you have absolutely no control. And also because you put some money into a crappy project and it got rug pulled on you. Squid Game, anybody. Anyways, I personally don't invest in shitcoins because obviously that's what they are. Don't get into it. You could do it if you want to. Actually, I do throw some money into it. It's sort of like a lotto ticket for me, but I don't really call that an investment, okay? Rather, what I do is that I put in my money into great altcoins that, well, in the case that maybe I get stuck holding the bag, if the market decides to dump for a while, at least I know that my money is in some really good projects that I believe in and are gonna do well in the future anyways. So in the moment, I'm just gonna diamond hand it, baby. and just have unrealized losses. So if you do decide to go this route, what I recommend is basically kind of do the same. Stay away from the shit coins so that your stuff doesn't get basically jacked and get rug pulled, and just get into projects that, you know, make sense, that you know are good projects that are gonna do well in the future. Don't take dumb gambles. You know, that's just sort of goes without saying with pretty much any investment. And in my opinion, a pretty decent portfolio in crypto would be somewhere like 40% Bitcoin, 30% Ethereum, 20% high quality altcoins like Polkadot, Solana, Algorand, I don't know, Icon. You throw more coins over here that are like really good projects. Let me know what you're investing in the comment box below. And then the rest you can put it into low cap altcoins that obviously have a higher potential of, you know, of increasing ICOs, NFTs, whatever the case might be. But, you know, at least you're not putting all your eggs in one basket. And in cryptocurrency, guys, literally, I mean, you don't necessarily have to take on a lot of risk because you're already invested in crypto. That's risky already, and you're gonna enjoy the volatility. Even by investing in Bitcoin, Bitcoin goes up 3, 5, 6% every single day, or it can go down by that much as well. So it is very volatile either way. All right, that's basically it, guys. I know, again, not financial advice, obviously, but I understand that, you know, buying a house, the biggest hurdle, it's not the credit scores, it's not the income, it's always the money, right? And especially depending on where you live, that can be even more challenging for you. Now, I'm gonna leave you guys with this one, and this is basically sort of towards all of you that live in states where home prices are much higher than the average across the country. So I'm talking about people that live in California, live in New York, Washington, D.C., Washington State. You know, some of you guys that obviously have to get into much more expensive property. So if you have to buy like $1 million home, look, don't get too tied down about putting down 20% for your down payment, because nowadays you don't necessarily need to do that, okay? You can get a jumbo mortgage, which is a loan that goes above the conventional loan amount for just a 10% down. You're still gonna have great interest rates. You're not gonna have the mortgage insurance because jumbo loans don't carry PMI. But either ways, it's, you know, if you do have some money later on, you can just throw it back into the principal and then do what they call a recast. Now, not every mortgage lender and bank does a recast, so you have to kind of talk to whoever is going to do the loan for you, see if they accept, if they approve doing something like that. But again, you don't have to get hung up on the whole 20%. And by the way, for some of you who are looking to buy more expensive property, so I know this example was about 400,000, but if you need to go 500,000, 600,000, you know, the conventional maximum loan limit went up this year to 647,200. So you can still get a loan amount that high for just a 3% down. Also, don't get too hung up about putting 20% if you're trying to get rid of the PMI, the mortgage insurance, because look, I get nobody wants to have mortgage insurance, but if you have a really good credit score and you do even just a 5% down payment, your mortgage insurance is gonna be very cheap. And with home prices going up, the way they've been going up, or even if they don't go up this high again, but they do continue to go up, which they will, you will be able to get rid of the PMI very quickly. And also, there are companies out there, believe me, I'm a mortgage broker, okay? I do this for a living. I know mortgage lenders that can give you a 10% down payment loan and not have to put the PMI on it. So you have to do your homework, talk to whoever you need to talk, do your research, and you will find those options out there for you. Basically, it doesn't even matter what state you're in, all right? If you want to get more information, just throw in the comment box below. And that's it for real this time, guys. Thank you so much for watching. I haven't made a video in a while because I've been starting my own company. It's been a lot, so kind of had to put this on hold for a minute. But hopefully you did enjoy the video. And if you did, give it a thumbs up, give it the like for the YouTube guys, the gatekeepers. And also helps my channel. And also, I will make another video very soon about, I don't know, whatever. Just put in the comment box below. Thank you for watching. Subscribe if you like all the content. And again, thanks again. Later.